It's a great day at Equity, and welcome to the show. And I want to start off with a question. If you don't want your money, who's going to? In this episode, I want to discuss 4 ideas to earn over 4% on your cash. Why am I talking about this? Well, the Federal Reserve has increased rates 8 times over the past 14 months. Higher rates mean we should be getting a higher savings rate than before. I found many banks are not paying the interest to you and me. So, here are 4 methods to help you and me earn over 4% on our cash. Number 1, I-bonds are paying 6.89%. Number 2, 6-month Treasury is paying 5.11% today. 3, some savings accounts are paying 4% yield. And 4, some money market accounts are paying 4.6% yield. So let's take a closer look at this. We all agree our cash should be earning interest. This is the only good news about rising rates. Our savings rates should increase too. Yet, not all banks were created equal. Not all banks share the high returns with their customers. Some banks will only share those high yields if you have mega money with those banks. This talk's not about that. It's more about getting into a very safe investment with high returns, regardless of how much money you have. So let's look at the first option. Let's look at the I-bonds. I-bonds are a type of U.S. savings bond. We are used to the double E bonds, but there are I-bonds, which stands for inflation bonds. You can invest a minimum of $100 and a maximum of $10,000. The rate is locked and adjusted every 6 months. Now, once this money is invested, your cash is locked in for a minimum of 12 months. Plus, if you withdraw before 5 years, you pay a penalty, which is losing the last 3 months' interest. I did this back in November of 2021, started with a 7.12%, and then had 6 months of 9.62%, and now earning a 6.89%. My plan is to leave it in there until I can find a better investment, then I will withdraw. Yet, even with losing 3 months of interest, my average yield will be over 7%. My bank of 20 years was only paying me 0.01% versus 7% here. Super safe investment, and it can be purchased online at treasurydirect.gov. If you think inflation is rising again or staying flat, this might be good for you. Again, beware you can't withdraw it for 12 months. Also, a trick is the max is $10,000 per household member. So, you and your spouse can invest $20,000 a year. So the second option, let's look at the 6-month Treasury bill. Buying U.S. Treasuries are super safe. They pay interest every 6 months. This can be purchased online via treasurydirect.gov. The minimum amount of purchase is $100 and maximum is $10 million. Currently, the yield is 5.11%. So think about this. The Federal Reserve is meeting next month and expected to increase rates again. You might be able to get a rate of 5.25 through 5.50 next month for 6 months. If inflation is indeed sticky, in the next 6 months, the rate/yield could easily still be 4 through 5% more. This would give a yield of 9 through 10% for 12 months, which is more in line with stock market expected returns, but so much safer. So why not look at 6-month Treasury bills? Just remember, you are locking up your money for 6 months. And now the third option. If you don't want to lock up your money, look at a Morgan Stanley Premier Savings account. Today, it's paying 4% with no fees or withdrawal limits. The minimum is $100 savings and no limit on the maximum. This does come with FDIC insurance and pays a 4% yield, very little risk. Yet, compared to some banks, paying a 0.01% or 0.15%, a 4% yield is head and shoulders over them. $50,000 in savings at 4% pays $2,000 interest versus leaving at my old bank, which is 0.01, which pays $5 in interest. So my final suggestion, number 4, if you want a little bit more yield without locking up your money, look at a Vanguard Treasury Money Market Fund or the Morgan Stanley Money Market Fund paying a 4.60% compounding yield. Again, it's only a $100 investment and very safe. So basically, it's time we all check our savings interest rates and move money around to benefit you. An old-fashioned saying is always pay yourself first. And this is our time to make sure we are financially fit. There is no right or wrong in which one you select. So many factors play a part on making any investment decision. I just learned if you do as you always have, and you're with a bank that doesn't keep pace with the current markets, then it could cost you a significant amount of money. Take a look and make the best decision for your specific situation. And if you have any other safe, high-yield investment thoughts, we would love to hear them, so put them in the comments below.